Well, good morning, or good afternoon, everyone. Welcome to Trading a Smaller Account. My name is Barbara Armstrong. And today, I am not a psychologist and I am, this is not a psychology class, but the psychology of trading is very important. And today somebody said, let's end the week strong. And I think there is a lot of strength in admitting when you're wrong. And so we're going to look at some trades that went wrong today and go back and do a quick postmortem on those. We've got four new example trades that we want to place, all of which are in the bullish spectrum. And we're kind of now we've got earnings season starting again. It feels like we just finished. In fact, there were a couple of stocks that had earnings announcements, a couple of companies that had earnings announcements next week, but we start in earnest with the next earnings season next week. So yeah, we've got a lot to cover is the net of it. We've got both people that are here for the first time in this class live today, and we've got a lot of our usual suspects. I'd like to welcome you one and all. We've also got James Boyd with us in the chat. He's a friend and a fellow coach. We have a lot of fun teasing each other. I just came across the pictures of the flags. 4 dozen Canadian flags, who's counting, that I planted in James' yard and crisscrossed on his truck. They were in his mailbox. They were everywhere. And I laugh every time I see them. I haven't had the heart to throw them out yet. Yeah, and he apparently gave them out for Halloween. He was probably sad on Canada Day when he didn't have those flags to celebrate. But welcome everyone. Hi to Paul and Jan and Jay and Virgil and Josh and the rest of the gang. Thank you all for being here and for bringing so much positive energy to this class. We've got Will from Texas and Kevin in Austin and yeah, and the rest of the gang. So without further ado, let's get through our important information so that we can get right out to the platform and get into what we have to cover. If you're not following James and I on X, I don't know what you're waiting for. It's worth opening an X account just to be able to follow the coaches. I follow motivational people and trading people, and that's all that comes into my feed. So you only have to participate in that which is of interest to you. So at Barb Armstrong CS, at James Boyd CS, be there, be square. Keep in mind, we do a lot of options trades in this class, although 3 of the trades we're going to review today are stock trades. But options carry a high level of risk and aren't suitable for all investors. The paper money software application on the Thinkorswim desktop platform is where we place all our example trades. And know that there are some nuances and differences. One is that in paper money, short option positions will never be assigned early, and that can happen in a live account, but it won't happen in our paper money account. Okay, we're going to do a super quick market overview. This morning, James and Kevin Horner in Trader Talks did an awesome job. That wasn't archived, but 4 days a week, Kevin Horner, does a market overview at the market open. You want to tap into that. We're going to do a little bit of trade review and management. There's one that I'm kind of excited about managing today, and you'll see that in a minute. But we're going to also place a bunch of new example trades. So that's what's on the menu for today. If you are new, just know we started this year. We reset the account at the beginning of every year. We started the year with 25,000 in our paper money account. Our max position size is 5,000, which is 20%, which may seem pretty high. If you had $1 million account, you may want to make that number 5%. Which would still be a bigger number than 5,000, but as a percentage of your portfolio, not as a percentage of your portfolio smaller. And our max trade risk is 500 to 550, which is 2% of our original volume, or our original portfolio size. And again, if you had a larger account, you might want to make that like half of 1% or a third of 1%, or like whatever your number is. And our focus is on the short to intermediate term time frame. When the market's bullish, we tend to trade bullishly. When the market's bearish, we tend to trade bearishly. But we're in the moving business, not the storage business. We are not trying to create long-term love affairs with our positions. And in fact, love and hope are kind of four-letter words in the world of trading, you'll notice that they are not part of our trading plans. And there's a reason for that. Okay, so if we have a quick look at the SPX, I mean, it is up over 10% year to date. Over the last 30 years, the S&P in an average year, and we've had down years and we've had up years, but on average, it's averaged out to about 10.6 or 10.7. So, and we're just, in the first half of July and we're already up 10%. So, we had this huge move to the upside and then a panic pattern. Looks like we're breaking out to the upside. And it really depends on where you've drawn your lines, but that's the art of technical analysis. If you're new to technical analysis and looking at charts, you may want to join me on Tuesdays at 2 o'clock Eastern. But the NASDAQ, another big move, another pennant pattern setting up. And, it looks like it's kind of bouncing off this support level currently. Yeah. Yeah. How about the Dow? But pretty hard to qualify it as anything other than overall bullish. And, we hit a new all-time high on this index at the beginning of the week, the Dow 30, a bit of a bull flag setting up. Let me just grab my drawing tool. Although I'm sure you guys can all kind of see that for yourself. And today we have a, close above the high of the low day, it would appear, perhaps setting up. So that's our Dow. What about the small caps? Well, they're looking pretty darn bullish too, right? A little bit of consolidation happening over the last week. And again, I'm going to get rid of these drawings. What I'm seeing now, if I'm playing, I Spy with my little eye, is more of this kind of like a bull flag type pattern here. I'm waiting for that breakout. Okay. And what about volatility? Oh, where did my VIX go? Volatility is really at the low end of the range. This is a 6-month chart, and it hasn't been much lower than this, in the last 6 months. If we bring up a year-to-date chart, again, we're at the low end of the range. We're not at the year-to-date low of 14, but, compared to where we were, at the beginning of June, we've come a long way, baby. Okay, so that's just a quick and dirty on where we stand. Now, I'm going to do a couple of example trades, and then we're going to look at 3 trades that we placed on Monday, and then we're going to do a couple more. And we have 1 trade that we have to manage as well. But I have spent a lot of time at Home Depot in the past week, and with all the stuff I bought there, I've got to be driving the stock up. And I say that tongue in cheek because, I've made many trips. I've spent hundreds, but not thousands. But, when we look at this, what kind of pattern do you see potentially setting up? Well, I say, if I'm playing I Spy with my little eye, this kind of looks a bit like a potential. And it just depends on the bounce. Like, we're kind of coming around the bend. If it comes back up to here, might this be, an inverted head and shoulders? Now, some might say, well, it's not there yet, so I'm going to wait for it to break out and maybe come back to retest and then place a bullish trade. And that's totally legit. Trader Joe is seeing a flag. A flag. I do not say fleeg. I don't know where James gets that, but James has his own world. Yeah. So anyway, but could we also say, I am going to trade it up to here? Like it may come up, it may break through, it may not. but could we do a long call, like do a swing trade up to the previous high? Yeah. So, in fact, I'm going back to the depot today after work. Okay, so could we do another long call? And that's not a recommendation that you shop at Home Depot or, but if we look out and we say we're expecting this to be a short-term trade, and so the temptation might be to only buy a call going out a short period of time. But by paying more for the call, and if we're looking at this, if we look at theta, you're saying, well, I expect it to hit this target by the middle of next week. So I'm only going to go out to July 24th. But then what's the time decay damage for something, an option that's in the $5 range? It's 26 cents a day, on this $5. So like that's 5%. Where if we come out to August and we look at an option that's in this $5 range, our time decay is 13 cents a day. It's half. Okay. Yeah, the more lines you draw. So BJ's saying the teacher's eyes are so good. I didn't see that inverse head and shoulders. Well, it's not even complete. So I'm just looking for what may happen. And so we're going to come out to August, or sorry, here's August. Yeah. So we're going to come out to August and our max risk per trade is 500. And when we buy a call, how much could we lose? Well, we could lose all of it. And this is a swing target, and we're going to make our target $354. It's currently trading at 343. And you might say, well, that's not much of a move. Well, you know what? Doesn't have to be much of a move. So we're going to come out here to our 440 and our example trading plan. I'm just going to come back here and switch this back to my basics. So the question you might ask yourself is, well, and you should ask yourself is, how many contracts do we have here? Is it at least 10 times or 20 times the number of contracts we're going to trade? At 1,300, we're going to do one contract. Do we have a tight bid-ask spread? Is it less than 10%? Yes. Does this stock typically trade over 1 million shares a day? Yes. So check, check, check. Do we have a technical entry on the chart? Check. Okay. Check. Okay, so we are going to buy custom with an OCO bracket. So we're going to make this, oh, for crying out loud. Sometimes let me log out and log in again and see if it will cooperate. I kind of hate to take the time to do that. We're going to make these good till canceled. With a swing trade, we get out if it goes below $2, if it goes below 50%. So if it goes below 243, we want to exit. So that's half the value here. Now, it's making me put a limit price in. So it's not letting me change this. And I'll change this after the class, but I'm going to put in a condition on this. And the condition is that I want this to be the value of Home Depot to be 354 or higher. Okay, so one of the ways I can get around this hang up, and what I typically do with this is I make this a market order, and for some reason, it's not letting me do a market order. Okay, so I'm just going to make my limit the current price. It's like I want to get at least what I paid for it, and it has to be trading above $354. Okay, so this is just me getting around a system glitch. Typically, we'd say sell this at the market price if it goes at or above $354. And if this option loses half its value, I'd like to lick my wounds and exit. Now, why am I not putting in two contracts, because if I'm saying I'm going to get out if I lose $243, I could afford to lose 480, right? It's because if it gaps down, I could lose more. So we're trying to err on the side of caution. Not that we expect to have a losing trade. We never place a trade thinking it's going to be a loser, but every trade has the potential, to not go the way we want it. And so this is a note we're putting in from ourselves to ourselves. This is our swing target. And this is just my way of getting around this system glitch I currently have. But the way I would typically put this in is as a market order to get out. Now, you may be saying to yourself, how much could I make if it goes up and hits my target in the next week? Like, just out of idle curiosity. So we've sold this August 21st 370 strike. The reason we picked this strike is because it was what we could afford. Then I'm going to come here and the first thing you do is hit reset. And so our target's 354. So we're at 342.67. So that's about 1150. So I'm going to add 1150 and hit enter. And that gets me to my 354, which is our target. And then I'm going to say, well, what if it takes, and we're not expecting it to take long, like what if by next Wednesday it goes up and hits our target? Now, this is giving us kind of a guesstimate, right? Because I'm not changing volatility. It might, if it hits like a week later, that will impact the profitability. So we paid, let's say we paid 480 for it, it would be worth about 713-ish. So if we say 713 divided by, and I don't remember what we got filled for, but we call it 480, that's about a 50% return. Now, what if it takes another week? And you can come in and play with this. If it takes another week, then we go from making $7 to making $5.91. So time decay is a real thing. And so that's our swing target. And if it gets up to like 350, 385, and then we see a doji or a candle pattern indicating that it may not quite get there, can we go in and change our exit? Of course we can. But and this tool I thought was the coolest thing on the planet when I first saw it in a class, because I started, as many of you know, as a student. And so just in case, because I ended up calling the trade desk, I had them on speed dial when I first started. This is on the trade tab, part of the option chain, and you change it to Theo, price, and mark, and then this comes up. And then you click this, and there's a little drop down, and the first thing you hit is reset. Okay. Okay, so there's trade number one. Let's go to trade number two. Now, my kids tend to love this store. It's not a store that I tend to go into very often, unlike the Depot. This is Target. And so like Target's up 38% this year. So like obviously somebody's shopping there. And we've had it come down to this support level. It's kind of been weaving in and through, the 30-day moving average, which is my red line, and the 10-day moving average. So maybe it's hitting more of a 50-day moving average, but it's come down and bounced. We had this Harami pattern happen on Monday. Okay. At least I'm going to answer your question in just a second. But, and it's bounced. And so could we look at that and just say, well, this is an uptrending stock, as we see by this year-to-date number, it's bounced here. I'm going to do, could we do a long call vertical? And what we tend to do is bracket the price. Now, when I first looked at this morning, it wasn't trading above 135. So I did the 130, 135. And let's see if we could still do that. And we're on the other side of earnings. So we don't have to worry about earnings, because some people will have as part of their trading plan that they don't want to place a long vertical trade or a short put vertical trade over earnings, and others will do it as an earnings trade. It just depends on your tolerance and appetite for risk. But if we kind of look at this and say, well, could we come out even to August? And this is less directional if we say, and again, does it trade typically 1 million shares a day or more? Yes. Does this have high volume? And this open interest is number of contracts that were on the books when the market opened today. So it has high volume, acceptable bid-ask spread. That's like 35 cents. So like 5%. So could we buy a vertical? It's already through both strikes. Holy smokes, Batman. Like, oh, sorry, that's the 135, 140. Let's see if we can go 130, 135. So it's already through both strikes. It just has to stay at that level or above by August 21st. We're paying 268. Now, in this class, when we do a long vertical, our example goal is 50%. Now, we could make more than that. We could make, $232, which divided by 268, that's 86%. And I used to, when I first started, I wanted, if I could make an 86% or 100% return, man, that's what I wanted. But, I seldom got it. And I was so frustrated. And I thought, well, like, is a 50% gain all that bad? Like, that's not too shabby. If you said to somebody, if in approximately a month, like this wingnut, I listened to her webcast and she was suggesting I get out making a mere 50% return. Like, they're going to ask you if you can do this legally. Are you committing a felony to do this? No. And so, like, if we look at this and say, well, if we did 2 of these, we're risking about, $530 some dollars. If we're okay with that, we're going to do 2 contracts. We're going to right click, create an opposite order, and then 270 times 1.5, that's 405. So when this gets to 405, we want out. Now, if we're down 50%, we also want out. So why are we not doing an OCO order? Because sometimes when the market opens, there's a lot of volatility. And if that gets us out for a 50% profit, we're willing to take that. But we don't want to get stopped out for maybe more than a 50% loss unnecessarily and then have the market settle down and it turns out we wouldn't have been stopped out at all. So we're risking 540 and we're saying, hey, if we can make a 50% return on that, we're going to be happy campers. So we're putting that in our long call vertical bucket. Okay, so that's Target. So 2 trades, 2 different trading strategies. Okay. Okay. So DJW is saying if you're working with a small account but don't have the clearance to trade verticals, so you could apply for clearance to trade verticals if you want to do that. Otherwise, you can, do this single leg options. The problem with single leg options on some stocks is that if it's a very expensive stock, like we're going to look at AMAT as another example today, and when you look at the options, this is a $600 stock now. So when we look at a single leg option price, this is expiring in 14 days. So you go out to August for $70. That's you're risking $7,000. Our max risk is 5. So you could, so if you apply and you're denied, you can call them back and ask if there's something you can do to get approved earlier and let them know you're coming to classes and that kind of thing. So I would say call the customer service desk and ask what you can do about that. Okay. Now, somebody asked me how I choose my examples, and I'm going to go through my highly complex process with you. Are you guys ready? Buckle up. This is a big one. And it didn't take me long at all because what I did is I linked my watch list to my charts and I went through the NASDAQ, the Dow, and the S&P 100. And I looked for things that didn't have a little blue circle beside them, which means earnings are coming up. And I clicked on them looking for bullish examples. So here's a bullish example. We're going to come back to that one in a minute. And then when I went through this, and it's pretty quick because there aren't that many stocks that don't have earnings on the horizon, right? And that are bullish. So that was it. And then I switched to the Dow. Well, the Dow only has 30 stocks. And, there's how many? Amazon. And then some of them are on all your lists. So CRM, that's not exactly been bullish. So we're moving on. So Cisco is another one that we're going to look at. So there's my big reveal on like, I very much go with the KISS principle, guys. I don't do a lot of complex stands, like that's it. Yeah. So American Airlines, we're going to talk about those on Monday. We're going to talk about all of the buy rights except one we're going to talk about today. Okay. We're going to talk about those on Monday because I can only cover so much and I want to cover the trades gone wrong. So let's just take a minute. We placed 2 trades and on Monday we did 3 trades. So we did one on SanDisk where we bought, and this is such an expensive stock, it's almost $2,000. And when we placed this trade, there was a bullish Harami pattern here. And so here was our target. And the next day, like so many tech stocks got like hammer smashed. And we ended up out of that for a loss. Like our timing was like perfectly imperfect. Okay, but if I look at this and this was a bullish Harami when we placed it, did the entry make sense? Like this is a stock, it's up 700% year to date. It had come down. We had this Harami pattern, which doesn't require confirmation. Maybe we wished we'd waited for it. The same thing happened with Micron. And now Micron seems to be working its way back up, but we got stopped out for a loss on that one the next day. And just to make the triptych of despair complete, we did Intel also, and that one also hit our exit. We put our exit, I think, 3% below this low. And so we lost on all 3 of those. Now, when we look back at it, were the entries, like if we go back and look at it, it'd come down to the 30-day moving average. We had this Harami pattern setting up, an inverted hammer. When we look back at it, was the entry still a legitimate entry? It was. But did it turn out to be a losing trade? It did. Okay, so how bad was it? Oh, it wasn't pretty. So if we come and we look at SanDisk, for example, and this is when you're really grateful that you did, and you know what I'm going to do? We're just going to not pick a stock, and we're going to go back 5 days because we placed these trades on Monday, and that way I don't have to keep bringing them up different screens. I'll just change. Okay, so here we go. And I'm going to go through these pretty quickly. I've already done the math, but I think it's important to acknowledge when you had something that didn't go according to plan and then look back at it. And so we bought this on Monday. It hit our stop on Tuesday. And so this is our SanDisk. And we were down, and you just take 1 and subtract. We were down $157.67 a share times 2 shares. So we were down $315.34. And while this trade did not make money, so like we were kind of ticked about that, our petunias officially frosted on this one. I'd say it was a successful trade in that, did we position size correctly? Yes. Did the entry look legit when we placed it? Yes. It's just a trade that didn't make money. And then, to go along with that, we did our trade on Micron, and that too didn't go according to plan. And so with this one, when we subtract them, we were down a mere $89.48 a share. And again, this is where we're grateful that we honored our position sizing rules. So we can pat ourselves on the back for having that self-discipline, but we were down $424.90 on this one. So again, the frosting of petunias continues. But did the entry make sense? Did our position sizing, was it appropriate? Did we follow our rules? Again, it was just one that ended up not making money. And then to round out our despair, all three of these stocks got hit, and we were in on Monday and out, the next day. And on Intel, we were down $10.21 a share. Woohoo! But, we had 42 shares. So that was 428.82. So not a good day in the old trading a smaller account. So in total on these three trades, we were down $1,169.06. But when we looked at this one again, was the entry still valid when we went back and looked at it? Did we position size appropriately? Are any of these numbers higher than 500? They are not. It was just another trade that didn't work out. Okay, and that's, somebody said that's trading. But our goal in this class was to average, our original goal was to average $100 a week. And I picked that because somebody said, you're crazy to think that you could make on average $100 a week on a class, on an account size that small. But I Googled it, and we are 27 weeks into the year. I did the math and wrote it down somewhere. So our goal would be to be up 5,400. And even with this loss, if we started at 25,000, that would mean we'd want to be at 30,400. And we have, we still have some buffer. But this is why it's important to have buffer and to plan on weeks that don't go according to plan, because this was certainly one of those. Okay. Okay. So, and I don't want to sweep these under the rug and pretend they didn't happen. And we have one more trade that, we've done a wash, rinse, repeat on this one, and it's Nokia. And Nokia, the second time around, the first time around, it was like textbook perfect, and we could have thrown our shoulder out for patting ourselves on the back. And then this time around, it's kind of gone to where in a handbasket. And so we placed the trade on this day. We did a protective put, which said like, hey, if this goes below $13, we want to be able to exercise our right to buy this, to sell this stock at $13. And we had our covered call up here at 17. So when we come and look at this in the monitor tab, we're down, it's saying 672. Now, is that more than 500? It is, but the covered call we sold, we made $231 on. And so what we're going to do here, because you can see we no longer have the covered call, but we have this put that we bought that gives us the right to sell the stock at 13. And so I thought I'd just do this as an example, so that you can see how you could exercise a protective put. Now, we could also just sell this. We could sell these puts. We won't have made much on it, but we could, exit this. And so we are going to exercise our right here to sell these 300 shares of stock at $13. Okay. Confirm and send. And often with these buy rights where the intention is to be called out, we aren't necessarily using protective puts, but on this one we did. And so now we're out of this position. Okay. Okay. So that's Nokia. I have a bunch of notes here. So that's that one. And the other covered calls, and on some of these, we're in the money. And we're going to talk about, do we, take the money and run? So Fitbit, we did a covered call at $55, and it's now at $56.92. And American Airlines, we could buy back our call here, but we'll do that on Monday. Okay. And then CSX, we're in the money on that one too. And that was our goal when we placed these trades, was to sell a covered call in the middle of the road and to end up called out. But I'd like to be able to do another example trade. So we'll look at the other buy rights on Monday. Okay. And congratulations to all of us for having the courage to look at and review the things that didn't go according to plan. Okay, so next trade, in, spoiler alert, I've already told you what we're going to look at. We're going to look at AMAT. And so here's another stock up 135% year to date, had a bit of a pullback. To me, this looks like a bull flag. We had a close above the high of the low day on Wednesday, and it's continuing to move to the upside. We do have earnings coming up August 13th, but if we come out to the monthlies, we can make sure we close it out prior to expiration. And again, this is one of those stocks that, we've got lots of volume here. We've got an acceptable bid-ask spread. It trades more than 1 million shares a day. So if we look at being modestly bullish, and by modestly bullish, like rather than buying, this is the 600 and the 610. So these are $10 wide when we go to the monthlies. If we look at the weeklies, we often will have $5 wide spreads, but we don't have very much volume here. And so that's why we're looking at going to this monthly instead. And it's interesting. It's like the prices are all over the place. So if we just take this at, now it's 483, what the heck? I'm just going to take 4 times, 1.5. That'll be $6. So if this gets to $6, we want out. We're only going to do one contract, create an opposite order. If we can make 50%, you might say, but Barb, you're leaving $4 on the table. Yes, I am. And why? Because I don't want to be, when I was a kid, we had an expression. You don't want to call it you don't want to be a greedy guts. We're not being greedy. If we can make a 50% return on this, we're going to be happy campers. Okay. So I'm going to send that in. Now, if it doesn't fill, because the prices on this are all over the place, so we can come in here and say, okay, you want 392. You know what? I'll give you up to $4. I just want it to fill. And hopefully then it'll fill. Okay, so I'll wait on that, and we'll just see where that goes, but I'll make sure that it gets filled. The other one I wanted to look at was Cisco. Now, Cisco, we already have a short put vertical on, and we put that trade on, I think last Friday. And it had come down and was bouncing off a support, an area of support that it had hit before. But now when I look at this, playing my usual game of I Spy with my little eye, I see now a diagonal resistance breakout, which is more bullish. And so could we, and now it's at 120, could we come to our trade tab and do say a 120, 125? Like when I first looked at this, I was looking at doing 119, 120. Oh, when is earnings on this? August 12th. So we don't want to go out to the monthlies. So if we go out to say August 7th, maybe we could do the 120, 121, on this. And now, but that bid-ask spread is kind of wide. So we might just say, well, if I come out here and we do this, we'll just make sure we exit prior to earnings. And we've got like 7,000 contracts here and a tight bid-ask spread and, lots of trade volume. So if this is 218, we can do 2 contracts and then say 218 times 1.5, 327. So if this does move bullishly, we might not be in that all that long. 327, good till canceled, confirm and send. And that's our long call vertical. Okay. So we've done 4 example trades. We've reviewed 3 trades. And then we exited a position on Nokia, a buy right covered call that we had sold a protective put on and demonstrated how to exercise that. Yeah, like our timing on those 3 trades on Monday was like perfectly imperfect, and I certainly did not do that on purpose. I was saying I was hoping these would all turn out to be grand slam type trades that could make us a bunch of money. And instead, they lost us a bunch of money. And sometimes that's the way things go. But, did it ruin my day? No, because I placed the trade, with a legitimate entry. We position size appropriately, and we prevented blowing up our account in spite of the fact that, we just exited 4 trades for a loss this week. Okay. So CB, we'll look at American Airlines on Monday. I appreciate you being with me. I've talked about example trading plans in this. So if you could do me a favor and hit the like button, if you haven't done that already, if you found this to be a worthwhile class, I'd appreciate it. This is Trader Talks. You're going to want to, oh, you know what? Let me just bring this over. I've already got it up. So what comes up is what's currently being taught. If you come to playlists, you can scroll down and find, every class that's taught on a regular basis. I also created another folder called the Trade Management Mini Sessions. And when you come in here, I've created this series that are now 14 strong on short videos on different candlestick patterns. And I think I put in what is a bullish harami, in the, that you could click on at the end of Monday's class. You may be wanting to throw something at me now for that, but, we did a short put vertical trade on Monday. That's, we've got an example trading plan for that. We've got an example trading plan for long call verticals. And next week, I will create one for swing trades. And so look for that to be kind of at the top of the pile here in the blue section. So guys, thank you so much for joining me today. Don't forget to follow James and I in the land of LinkedIn and in the land of X, Barb Armstrong CS, James Boyd CS. Have yourselves a really awesome weekend. Get out there and hug someone you love and stay tuned. There's lots of great content still to come your way today. Thanks, everyone. Bye for now.